Hello everyone, I'm Nova Lui, RHB Bank's Head of Investors Advisory. Welcome to our monthly podcast series. In the global front, 26 August 2022, Jerome Powell pledged to combat inflation and stressed that higher interest rate will be likely perceived for some time to reach the committee's 2% inflation target. US equity were down more than 3% on the same day the speech was made in the virtual Jackson Hole Symposium conference. In the first half of September, market starts to price in even possibility of up to 100 basis points in the upcoming rate hikes. Joining me today, I have Mr. Raymond Jing, Senior Vice President, Portfolio Manager of China AMC.
Hi Raymond, thank you for joining us on our monthly podcast series. US House Speaker Nancy Pelosi and other US lawmakers defied China's warning and visited Taiwan to discuss about the possibility of trade deals in future. China responded by carrying out major military exercise followed by routine patrol exercise around the Straits of Taiwan. Before this incident, there are discussions on potentially reducing or even uplifting the tariff on China goods in US to combat inflation. How has Nancy Pelosi's visit impact the economic relationship between US and China? And Raymond, is it the uplifting on the tariff for China goods still on the table?
Relationship between US and China led broad discussion as we saw drawback signs after Pelosi's visiting Taiwan. And Taiwan is the key issue in China geopolitical framework and unnegotiable. So one China policy is the fundamental of bilateral relationships of China and any other country in our point of view. So it's easy to tell Pelosi's visit led to a strong reaction from China. We saw military exercises around Taiwan after that, but it's quite clear that China doesn't want to retake Taiwan through military action, or we have to say military action is the last choice. But we did see that U.S. Senate Foreign Committee passed a Taiwan Policy Act recently, and President Biden signed CHIPS Act to further control semi-instrument export to China. So even we do wish economy relationship between U.S. and China can improve as better relationships benefit for both countries and both economies. But the possibilities of uplifting the tariff on China goods are coming down compared with the period these events happen. But from another angle, we have to see that China and U.S. trade dispute happened since 2018, right? And we found that trade between these two countries reached record high in last year in 2021 to $756 billion US dollars, and the year-on-year growth nearly 30%, and also the record high. So we do think even we saw conflicts happen frequently between US and China these years, but development seems still accelerating. So we need to be patient and optimistic on China economy and industry upgrade. That's my answer for your question.
Okay, thank you, Raymond. While China is still practicing dynamic COVID policy, has kept the infection figures low. It has come to a great cost to Chinese economy as lockdowns has all but stagnated all activities in the affected regions. To counter economic slowdown, China announced a slew of stimulus measures in August 2022, including regulatory support on the selling of China yuan to stem depreciation of local currency, cuts on short and medium lending facilities rate by 10 basis points to 3.65, also to cut 5 and 15 basis points on its 1-year and 5-year loan prime rate. There is also other monetary policy and fiscal spending to support ultra-high voltage power line, resumption of stalled housing projects, and to boost infrastructure spending. Exactly how effective are these measures? Especially the momentum of rate cut is relatively small. Would China miss its official growth rate of 5.5%?
We do think these supporting measures did help the economy recover from Q2 bottom caused by the COVID outbreak in Shanghai in China. And recently we find some figures we say optimistic. First of all, the consumption figure just announced that is over 5.5%. So the first time after Q2, we saw this figure coming back to over 5%. Well, we're pretty sure that credit data weakness indicate more stimulus is still on the way, and we thought such kind of a recovery can continue. And main uncertainty of China economy, in our point of view, still comes from the real estate market, because from January to July, the real estate investment down by 63%, while the infrastructure investment is up by 7.4%, and manufacturing investment actually up by 9.9%. And we're sure that the real estate market has already hit bottom, because we see more and more policies to aim to help the market to recover and to hit the bottom. But the market still expect the supporting measures on real estate industry to break the negative overloop and to recover. As real estate market, we do think rate cuts, as you mentioned, has clear positive impact on other areas, especially for the financial market.
Okay, Raymond, thank you very much for your insight. I trust that our investor will benefit from your sharing and give better perspective about the condition of the Chinese equity and fixed income market.
Let's move on to our home country, Malaysia. Today, we are honored to also have David Law, Senior Portfolio Manager of Affin Hwang Asset Management, joining us. Malaysia's budget 2023 will be tabled in early October, which market has widely speculated general election will be around the corner.
Traditionally, investor has perceived that equity market will be doing well prior to election, riding on the feel-good factor. David, do you think such rally or support will be repeated for this upcoming election? Any particular sector that we need to watch out for this event?
Hi, Nova. Thanks for having me. I think there are two parts to your question. The first one is regarding the timing of election, and the second one is about whether there will be a pre-election rally this time. So on the first part, as you rightly pointed out, there are growing speculation about Parliament being dissolved soon, right after the tabling of budget 2023 in early October. If you speak to political observers, commentators, if you look at movements of senior politicians who has been going around the country for campaigning, they all seem to be pointing towards that direction. But having said that, we would caution against trying to second guess the timing, because there are way too many factors for the Prime Minister to consider before calling for one. Firstly, the Prime Minister needs to sort out internal party politics, getting the house in order first. Secondly, he needs to consider the sentiment on the ground, which is fragile at this juncture because of inflation, because of rising cost of living. And lastly, let's not forget that the full term for the current government expires in July 2023, which means that he has another 9 to 10 months to go before the term expires. So instead of trying to predict the timing, what we'll be focusing on is actually the final outcome of election. And as market participants, we would be looking out for a strong and stable government. Would be essential to enact the right policies in taking the country forward, and also focusing on key issues such as inflation, addressing labor shortage, and of course to attract FDI. On the second part of the question, whether there will be a pre-election rally, personally, I don't see it happening this round. Historically, pre-election rally always happens when the underlying economy is booming and the incumbent is strong. But what we are having right now at this point in time is probably the exact reverse, where the macro condition is challenging with US inflation and of course Ukraine war, which is bringing a lot of uncertainty. And the current government, the incumbent, is actually quite weak. So we don't see that happening. We think that market movements in the near term would probably be more dictated by macro conditions rather than any election optimism.
Thank you, David. So you shared that some sectors that likely doing well prior to the election previously, such as the construction sector. So this round could be different, but then what are the areas that now you think will be doing well in the upcoming election or after the election?
Okay, at Affin Hwang, we are defensively positioned right now because of the challenging macro backdrop. Our positions are mainly in large cap blue chips with low gearing. And this is very important because we are going to a rising interest rate environment. Our funds are mainly positioned into three key themes. The first theme that we have is banks. Banks is a very obvious choice simply because we are going to a rising interest rate environment. The second theme that we like is reopening. This is mainly supported by relaxation of COVID policies and of course with the opening of borders in May. So within the reopening theme, we have subsectors like gaming, the likes of Genting, we have consumer, we have commodities. And the third theme that we like is technology. The technology sector is mainly underpinned by strong secular trends like your electric vehicles, 5G, renewable energy, so on and so forth. And also not forgetting that technology sector is probably one of the worst performing sector this year, with all the key names dropping by about 30 to 40% on average. So valuation has become more attractive now after the sell down. So just a quick recap, key investment themes that we like are banks, reopening, and technology.
Thank you very much for your sharing, David.
Thanks, and it's a pleasure to be here.
Thank you everyone for listening to our podcast. We hope this will bring better insight to our investors to make informed investment decisions. If you have any inquiry, please contact your relationship manager or visit RHB Merge website for more of our other money chat and podcast series. Thank you and see you again in our next monthly podcast.